I'm Craig Popp with Accrue Wealth, and this is your first quarter 2026 market update. The first quarter of 2026 underscores just how critical financial preparation and sound investment principles truly are. Following robust gains in 2025, markets have contended with a confluence of geopolitical shocks, elevated oil prices, and renewed economic uncertainty. The conflict in Iran, which erupted at the end of February, quickly became the defining market narrative of the quarter, sending oil prices sharply higher and triggering the year's first notable market pullback. By the end of March, however, ceasefire discussions began to surface and the situation remains fluid. Markets have still delivered impressive results over the past 12 months. Across various segments of the market, sectors such as energy and defensive areas have lent meaningful support to portfolios. Looking ahead, new questions will likely emerge in the coming months, including the upcoming leadership transition at the Federal Reserve and the midterm elections later this year. The S&P 500 experienced a total return of negative 4.3% in the quarter. The Nasdaq was down 7%, and the Dow Jones Industrial Average declined 3.2%. The Bloomberg U.S. Aggregate Bond Index was flat for the first quarter of 2026, while the 10-year Treasury yield ended the quarter at 4.3% after falling as low as 3.9% at the end of February. Developed market international stocks were down 1.1%, and emerging market stocks declined 0.1% for the quarter. Oil prices spiked, with Brent crude reaching $118 per barrel at the end of March after beginning the year around $61. WTI ended the quarter at $101 per barrel. Gold ended the quarter at $4,668 per ounce after climbing as high as $5,400 in January. The US dollar index strengthened slightly to 99.96 over the same period. February inflation showed headline CPI rising 2.4% year over year and core CPI climbing 2.5%. The core PCE price index, which is the Fed's preferred measure, rose 3.1% year over year in January. The Federal Reserve kept rates unchanged within a range of 3.5% to 3.75% at both meetings during the first quarter. It's natural to draw comparisons between the start of this year and the beginning of 2025, given that both were shaped by global concerns. Notably, both first quarters saw the S&P 500 pull back by 4.3%. While last year's turbulence was driven by tariffs, and this year's stems from the conflict in the Middle East, the impact on investor sentiment has been strikingly similar. When uncertainty rises, markets naturally experience short-term volatility in response to evolving headlines. While past performance is no guarantee of future results, taking a longer view can help investors understand how markets have historically behaved. Despite the headwinds encountered in the first quarter of 2025, stocks went on to post strong gains for the remainder of that year, with major indices reaching dozens of record highs. The lesson is not that markets always rebound swiftly, but rather that market conversations often fixate on negative developments, meaning that recoveries frequently occur when investors are least prepared for them. Perhaps the most useful perspective is recognizing that pullbacks are a normal and unavoidable feature of investing. Since 1980, the S&P 500 has recorded an average intra-year drawdown of approximately 15%, even as markets have delivered positive returns in more than 2/3 of all years. A typical year sees 4 or 5 pullbacks of 5% or more. Last year saw 6 such pullbacks, even though the S&P 500 finished the year with an 18% return. This perspective may prove especially valuable as the midterm election approaches and fiscal concerns resurface later in the year. The most consequential market development of the first quarter was the escalating conflict in the Middle East, which drove oil prices significantly higher. Disruptions to the Strait of Hormuz, a critical passage carrying roughly 20% of global oil from the Persian Gulf to the rest of the world, led to production cuts among major oil-producing nations in the region. Brent crude ended the quarter at $118 per barrel, up over 94% year to date, while WTI surpassed $100, the highest levels since the conflict in Ukraine began in 2022. Oil prices will continue to respond to geopolitical developments, including any progress towards a possible ceasefire. Higher fuel costs affect consumers directly through gasoline prices at the pump and indirectly by pushing the cost of goods and services throughout the broader economy. The national average price of gasoline reached $4 at the end of March, and diesel prices have also risen considerably. While these developments do weigh on household budgets, economists generally regard these types of supply-side shocks as temporary in the context of the overall economy. This is because oil prices tend to stabilize once the underlying geopolitical situation resolves. A comparable dynamic played out in 2022 when gasoline prices climbed to $5 before retreating within a matter of months. While the current environment is challenging, significant financial hardship is not expected for the average American household at present gasoline levels. History also demonstrates that geopolitical events, despite generating short-term instability, have rarely derailed the markets over the long run. This includes the U.S. operation in Venezuela in January, which caught markets off guard but had little lasting impact on investments. While the current situation continues to evolve and carries significant humanitarian consequences, investors who made dramatic portfolio adjustments in response to past events often did so at precisely the wrong moment. Volatile energy prices represent just one dimension of a broader economic picture. Other indicators suggest an economy that has moderated over the past year while remaining fundamentally sound. This after many years during which predicted recessions failed to materialize. The labor market remains among the most closely watched indicators, and the latest payroll data reveals that February job gains fell by 92,000, with the unemployment rate edging up to 4.4%. Job seekers now outnumber job openings for the first time in years. As recently as 2022, there were 2 job openings for every unemployed individual, reflecting an exceptionally tight labor market. That relationship has since reversed. Context, however, is important. Fewer individuals are entering the workforce due to reduced immigration and an aging population. In other words, both the supply and demand sides of the labor market are cooling at the same time, which has helped keep the unemployment rate near historically strong levels. Investors pay close attention to employment data because it directly influences household income, consumer confidence, and spending patterns. Consumer spending accounts for more than 2/3 of GDP and has remained stronger than many anticipated over the past several quarters. Even as the overall S&P 500 has pulled back, performance at the sector level has varied considerably. In fact, 6 of the 11 S&P 500 sectors remain positive for the year, and the gap between the best and worst performing sectors widened to nearly 50 percentage points during the first quarter. The energy sector has been the standout performer, advancing nearly 40% through the end of March, as elevated oil prices are expected to boost revenues and attract further investment. Other areas of strength include consumer staples, utilities, materials, and industrials, all of which have benefited from a more risk-conscious market environment. Many of these sectors are often characterized as defensive, as they tend to represent more stable businesses with predictable cash flows that are less sensitive to the economic cycle. By contrast, the information technology sector has declined approximately 9%, and a number of mega cap stocks within the Magnificent Seven have underperformed. This marks a notable shift from recent years, during which a handful of large technology companies accounted for the majority of market gains. As always, it's important to maintain perspective on these moves. As the chart shows, sector leadership is dynamic and shifts with changing market and economic conditions. Energy was the top performing sector in both 2021 and 2022 when technology-related stocks struggled, a trend that then reversed over the following 3 years. As with asset classes more broadly, predicting which sector will lead or lag in any given year is extremely difficult, which is why a well-diversified portfolio is better equipped to navigate varying market environments. Trade policy took a significant turn at the end of January after the Supreme Court ruled 6-3 that the broad tariffs imposed under the International Emergency Economic Powers Act were unlawful. The administration responded by implementing a temporary global import duty under a different legal framework. The administration also launched new Section 301 trade investigations in March, while approximately a dozen Section 232 investigations remain ongoing. For investors, the central takeaway is that while the legal basis for tariffs have shifted, the broader policy direction remains intact. Tariffs will likely continue to influence the economy through consumer prices, business costs, and investor confidence. With that said, last year demonstrated that markets are capable of adapting to policy changes over time. Regardless of how the tariff landscape evolves later this year, remaining invested and avoiding overreaction to policy developments remains the prudent course of action. To conclude, the first quarter of 2026 challenges investors with geopolitical shocks, higher oil prices, and economic uncertainty. Yet, markets have been resilient with well-balanced portfolios and financial plans doing what they were designed to do. Investors should continue to focus on long-run goals in the coming months.